Okay. So we did the journal entries for that part of the question. And then we put the numbers in the accounts. Right? And then we had to do the trial balance. So the trial balance is just really taking the accounts, the balances, the final balances, and putting them in a list. Right? Just list all the accounts in the same order in which you saw them. If the account had a debit balance, you write the debit balance in. If it had a credit balance, you write the credit balance in. And then you total the columns. And the reason we do this is we want to make sure that the debits equal the credits, because sometimes when people do this part of the problem, they put things in the wrong place. And when you do that, your debits won't equal the credits. So that's kind of like a control feature to prevent you from making a mistake. All right, so that was problem 2. Okay. Could the people that have come late today, could you please make an effort to get here on time? Because it really fouls me up. And I don't want you to miss anything, but I don't know when you're coming in. All right, so please make every effort to do this on time. It's just less annoying for me. Okay, so that's it for chapter 2. We're finished with chapter 2. Analyze the transaction, think in terms of the accounting equation, assets equal liabilities plus stockholders' equity. Stockholders' equity is made up of common stock and retained earnings. Retained earnings was made up of revenues minus expenses minus dividends. Right? There was a chart that showed you that. Okay. So with that, let's start to talk about chapter 3. Now, chapter 3 is a tough one. Chapter 3, if you thought 2 was bad, chapter 3 is even harder. So what I've done is I made some notes here to help you, because this is a complicated topic, and it's kind of hard to read. So what I've tried to do is to condense everything into to make it easier for you to understand, and I tried to include some examples in here. So let's take a look at this. Chapter 3 is called the accounting cycle. Can you see my screen?
Yes.
Yeah.
Okay. Chapter 3 is called the accounting cycle end of period. Chapter 2 was during the period. So during the period, all the transactions take place. The things, if you think of what goes on in a business day to day, customers come in, they buy stuff, you have stuff you have to pay for, and you have your rent and your salaries and all the things you need to do to run your business. But then at the end of the period, you do your trial balance, but before you can prepare your financial statements, you have to do one more step. You have to do what are called adjusting entries. Right? So what I tried to do here is to give you some who, why, and when of adjusting entries. So for example, when do we prepare adjusting entries? All right, we prepare adjusting entries at the end of the period, after the trial balance, but before the financial statements are prepared. Now remember, these are journal entries. They're going to have a debit, they're going to have a credit, and then the numbers are going to have to be put in the accounts. Right? So these are just more entries. What makes these entries different than the other entries that we learned is that they take place at the end of the period, and the reason we do them is different. So why are adjusting entries prepared? we need to bring some of the account balances up to date. And the reason for that is some transactions begin in one period, but they end in another. And what adjusting entries do is apportion transactions between accounting periods. Now, there are two underlying principles that really tell us why we have to make adjusting entries. One of them is called the revenue recognition principle. And the revenue recognition principle says we have to record revenue in the period in which it was earned. Right? Now, we know something about revenue from other problems that we did, that we can only record revenue when work is done, or if we were selling goods, when goods have been shipped or delivered. So we can only record revenue in the period in which it was earned, not necessarily when the customer pays us. We learned about something called accounts receivable. Accounts receivable means we did the work for the customer, we have revenue, but the customer hasn't paid us yet, right? Revenue recognition principle, record the revenue in the period in which it was earned. We also have an expense recognition principle, which means we have to record expenses in the period in which they were incurred. Now, that's a fancy word, right? Incurred. What does that mean? The way I look at it is I say that the period in which the expense actually happened. In other words, I have a telephone, I use it every day, I make calls to my customers and so forth. And this is September, right? So I'm making phone calls during September. But when I get that bill from Verizon, it might say, you don't have to pay this bill until October 10th. Well, when did I use the phone? I made those calls in September. So even though I don't have to pay the phone bill until October, it's an expense of September because that's when I used the phone, right? So that's the simplest way I can think of explaining it to you, is that we record expenses in the period in which they happen, not necessarily when you pay. Now, you could pay the same time that you use something, right? In which case, then it would be okay to record the expense in that period. In other words, if Verizon said you have to pay the September bill on September 30th, well, then the expense took place in September, and I would pay it in September. But if Verizon says you don't have to pay until October, well, I still have the expense in September because that's when I use the phone. Are all accounts adjusted? No. Right? No. And here's something to remember, because a lot of students, whenever they don't know what to do, they use cash. You never, ever, ever adjust cash. Think about it. Can you create cash with an entry? Right? How do you know how much cash you have? You look in your checkbook to see what the balance is, or you look in your pocket to see what's in your wallet. Right? So cash is not something that is ever adjusted. Here's something else to keep in mind. Every adjusting entry contains an income statement account and a balance sheet account. An income statement account and a balance sheet account. Right? Every adjusting entry has that. Now, adjusting entries fall into two main categories. Your book doesn't show you this like this. They talk a lot about it, and it's kind of like a circular conversation. And I'm not saying that what they're saying is wrong, but it's just, to me, it's not organized the way I like to see it. So adjusting entries fall into two main categories. The first one is called deferrals. Now, whenever you see that word defer or deferral, it means something that happens later. Something that happens later. Now, the way I like to look at deferrals is that I have numbers in the accounts, but those numbers need to be changed or updated. Deferrals fall into two subcategories: prepaid expenses and deferred revenue. Now, we've seen these things before, but we never looked at them this way. What are prepaid expenses? Well, something that was originally recorded as an asset, but that changes over time. It can expire, or it could actually something that gets used up. What are examples of that? Well, we've seen things like prepaid insurance, when you buy the insurance policy today, but you have coverage for a year. We've seen prepaid rent, where you pay the rent for the entire year today. Prepaid advertising is another common one. You pay for your advertising in advance. Those are assets. And what's going to happen over time is that these expire, right? The insurance expires, the rent expires, the advertising, well, it kind of expires, right? Other examples would include something like supplies and depreciation. What adjusting entry gets made? Debit and expense, credit and asset. Or in the case of depreciation, we have something called a contra asset. So debit expense, debit insurance expense, debit rent expense, credit advertising expense, credit supplies expense, debit depreciation expense, debit expense, credit asset. Deferred revenue. Remember in the homework problem we did with the sewing shop, right? The seamstress, Udi, remember that one? Remember Bob came in to get his suits altered and he paid the seamstress in advance? That was a liability, remember? I think the amount was $700 if it was if I remember right from the problem. So what entry does the sewing shop make? Debit cash, credit deferred revenue. Why? No work has been done. Remember, you only have revenue once work is done. If the customer pays you before you do anything, that's not revenue. It's deferred revenue. It's postponed revenue. It's revenue that's going to happen later after the work is completed. So in that case, with the sewing shop, you would debit cash, credit deferred revenue. Once the work is completed and the customer comes back to pick up the altered suits, debit deferred revenue, credit service revenue. Okay. So we have revenue once the service is performed. Originally recorded as a liability, it becomes revenue once the service is performed. And the adjusting entry is a debit to a liability. Deferred revenue is the name of the liability, and credit service revenue. So those are the two examples, the two categories of deferrals: prepaid expenses and deferred revenue. The other big category is called accruals. Now with accruals, something's happened, but it hasn't yet been recorded, and you could argue that it should have been. And sometimes it's just the way the accounting system functions that it wasn't recorded. So under accruals, you have two subcategories: accrued revenue and accrued expenses. What's accrued revenue? It's revenue that's been earned, but hasn't yet been recorded. The example would be work that was completed, but not yet recorded. What entry gets made? Debit accounts receivable, credit service revenue. Right, now let's talk about this for a second, because when you first hear this, I don't know, it sounds kind of weird. Okay. I don't know what just happened. I don't know what just happened to my. Okay, so we were talking about accrued revenue, for example, right? I don't know what happened to my notes. Right, but accrued revenue. What if, take a doctor, for example, right? Now, a doctor sees patients. How does a doctor earn revenue? By seeing patients, by treating patients. So the doctor typically will see patients, and maybe the practice is to send the bill out the next day. So the doctor sees patients, and then they send the bills out the next day. I'm just using that as an example. What if the doctor saw 10 patients on September 30th? You know, somebody comes in for the flu, somebody else has a cut, somebody else has something else wrong with them, right? The doctor sees 10 patients on September 30th. September 30th is next week, next Wednesday. But the doctor's practice isn't to send bills out until October 1st. When did the doctor make that revenue? When did the doctor earn that revenue? On September 30th, when the patients were seen. But if the doctor doesn't send the bills out to the next day is in October. That's the next accounting period. So that revenue really should be recorded in September when the patients were seen. So the doctor needs to make an adjusting entry, debit accounts receivable, credit, service revenue. Now, what about accrued expenses? Accrued expenses. An expense that we had but didn't get recorded. Well, one example would be the one I gave you a while ago about the telephone bill, right? We get the telephone bill for September, and it says you don't have to pay until October 10th. Well, when is it an expense? In September when you use the phone, or in October when it gets paid? It's an expense in September when you use the phone. So in a case like that, you would have to debit an expense and credit a liability. Debit telephone expense, credit accounts payable, for example. Another example might be if you borrowed money from the bank, right, and the bank charges you interest, but you don't have to pay the interest until you pay back the loan. So what if you borrowed money for 3 months and the interest is $50 a month, but you don't have to pay the interest until you have to pay back the loan 3 months? Well, every month you have $50 of interest. Every month you have to record that interest as an expense. Remember the expense recognition principle, you record expenses as they're incurred. Debit interest expense, credit interest payable. Another example would be salaries. Debit salaries expense, credit salaries payable. How does that work? Well, most people get paid on Friday. Most people get paid on Friday for 5 days worth of work. Well, what if next Friday is what? It's October 2nd. So the paycheck that you get on October 2nd is going to be made up of 5 days, 3 days in September and 2 days in October. you have to record as an expense the 3 days worth of salaries that the employees were entitled to in September. Debit salaries expense, credit salaries payable, right? So let's go through the book now and let's see some of the examples they use, right? They talk about revenue recognition. Revenue is recorded in the period in which goods and services are provided to customers. Expense recognition. Record expenses in the same period. That's what they do here is this. Oh gosh. They say that there's a relationship between expenses and revenues, that we only have expenses in as much as they help us to make revenue. So what they're saying here is that you can only record an expense if you can match it against revenue. That's kind of a hard thing to visualize, right? But I think this is the point they're trying to make. They're trying to say is that if you record revenue in the periods in which goods and services are provided to customers, you have to also record expenses in the period in which goods and services are provided to customers, right? So that's what they're really trying to say there, but they don't say it in so many words. They talk about cash basis accounting. I'll just mention it to you here now. Cash basis accounting is the opposite of what we need to know. What we're learning is what's called accrual-based accounting. Cash basis accounting says you only have expenses when you pay for them. You only have revenue when the customer pays you. Now think about that for a second. If I did work for a customer in September, but the customer doesn't pay until October, when did I really make that revenue? I made it in September when I did the work for the customer, right? So that's the way we have to look at it, that we record the revenue when we do the work, and under the cash basis, you only record revenue when you receive cash. And for expenses, we record expenses in the period they're incurred, and under the cash basis, you only record expenses when you actually pay for them, right? Now, can anybody use cash basis? Are there some companies that can use cash basis? Yeah, the very small ones can get away with it. But bigger companies are all required under generally accepted accounting principles. You must use accrual basis of accounting. Cash basis is like taboo, no good. Right, and here they tell you that cash basis accounting is not generally accepted accounting principles. All major companies use accrual basis accounting to record revenues when goods and services are provided, and to properly record expenses in the period those costs have been used in company operations. All right, and then they introduce adjusting entries to you. All right, now look how they present it. I told you this was called deferrals, right? And that's basically what they're telling you here without using that word, that deferrals fall into two main categories: prepaid expenses and deferred revenue. With prepaid expenses, you pay for something before you use it. You pay for the insurance in advance, you pay the rent in advance, you pay the advertising in advance, right? You buy the supplies in advance. You buy the equipment in advance, and then over time, the asset expires. With deferred revenue, we receive cash. We receive cash before we provide any services, a liability is created, and then when the services are provided, the liability goes away and we recognize revenue. So prepaid expenses start out as assets and they become expenses as they expire. Deferred revenue starts out as a liability, but it becomes revenue when the services are provided. All right, now these are accruals. I like to accrue revenue first, right? Accrued revenue, we provide a service. but it hasn't been recorded. Right? We record revenue, but we also have to record a corresponding receivable account, and then eventually we will get cash. With accrued expenses, we used something, we created a liability like accounts payable or interest payable or salaries payable, right? And eventually that gets paid with cash. Right? So here's an example of the prepaid expenses, prepaid rent as an example. And this is goes back to the soccer academy where they paid for 1 year's rent in advance. If you remember, they talked about that. I believe that was in chapter 2. So what happened? They paid a full year's rent in advance on December 1st. Debit prepaid rent, credit cash, right? They did that on December 1st. But now, as of December 31st, what happened? 1 month has passed. 1 month has passed. So on December 31st, do we still have $6,000 of prepaid rent? If 1 month has passed, if 1 month has expired, notice that this went from 6,000 to 5,500. Why? Because if I take 6,000 divided by 12, that means the rent is really $500 a month. Prepaid rent expires at the rate of $500 a month. What journal entry gets made? Debit rent expense, credit prepaid rent. Debit rent expense, credit prepaid rent. And the same would apply for something like insurance or something like, you could substitute insurance for rent, right? You could say, hey, what if I paid $6,000 for an insurance policy that gave me coverage for a year? Instead of prepaid rent, I would have called it prepaid insurance. Instead of rent expense, I would have called it insurance expense, right? But it's the same idea. Now, what about something like supplies? When you buy supplies, they're an asset. So here, on December 6th, they purchased $2,300 worth of supplies. $2,300 worth of supplies. Papers, paper clips, pencils, staples, folders, right? All the things you see that are used every day in the office. On December 6th, they bought $2,300 worth of those. But on December 31st, when they went to the supply cabinet, they saw that $1,300 worth of supplies remained. Well, if I bought $2,300 worth of supplies at the beginning of December, but at the end of December, there's only $1,300 in there, what happened to the difference? 2,300 minus 1,300 is 1,000. What does that mean? It means $1,000 worth of supplies were used. What entry gets made for that? Debit supplies expense, credit supplies. Okay. Now let's talk about assets like equipment, buildings, equipment. What separates something like supplies from equipment? The supplies have a very short life, right? How long does a pencil last you? A few weeks? How long does equipment last you? Several years? Right? Equipment would be things like a computer. My computer I have at my desktop is like 10 years old. I just refuse to buy a new one. Most people, when they buy cars, right, don't they keep the cars for 3, 5 years, maybe longer? So equipment has a much longer life than something like supplies does. So what we need to do with equipment is we need to take the cost of the equipment and spread it out over its lifespan. So in this particular case, and don't worry about calculating the numbers right now. In these examples, they pretty much give you the numbers. So what they're saying here now is on December 1st, I paid $24,000 for this equipment. They don't even tell you what it is, right? Not important what it is. You pay $24,000 to buy this equipment. This equipment is going to last you several years. But day to day, month to month, the equipment depreciates. Now, that's something that we should talk about for a second. Depreciation doesn't mean what most people think it does, right? A lot of people, when they hear the word depreciation, they think of market value. Well, that car it costs $20,000 brand new. It's 3 years old. It's only worth $10,000. But the other $10,000 depreciated. No, that's not what it means. In accounting, depreciation means taking this $24,000 and dividing it up over the lifespan of that equipment. So in this case, if we take the $24,000 and we spread it out over the lifespan of this equipment, it's depreciating at the cost of $400 a month. $400 a month is depreciation. What entry gets made? Debit depreciation expense. And look at this weird asset account. Accumulated depreciation. If you go back to my notes, and I don't know what happened to them, I said, when it comes to prepaid expenses, you debit expense and you credit an asset or contra asset. Accumulated depreciation is an example of what's called a contra asset. Contra asset. Contra means opposite. So if assets have debit balances, contra assets have credit balances. Now, why don't you just credit equipment like here? Remember here you credited supplies? Why can't I just credit equipment? Isn't it the same thing? Well, not really. Depreciation is an estimate, right? Depreciation is an estimate. So anytime we estimate something, we use a separate account for it, right? And we'll see there are maybe 3 times during the semester where we're going to use a contra account to help us estimate something. Now, in terms of what amount gets shown on the balance sheet, right? We paid $24,000 for this thing. $400 of it has depreciated. How much is left? $23,600 is left. This is the number that shows up on the balance sheet on December 31st. This $23,600, by the way, that number is referred to as the book value. What is the book value? It's the original cost minus the accumulated depreciation. And when we get to chapter 7, we go into this in a lot more detail. If you're really dying to know where they got that $400 from, what they said here is that when they bought this asset, they were going to keep it for 5 years. 5 years is 60 months. So if I take the $24,000 and I divide it by 60 months, it comes out to $400 a month, right? That's where the $400 came from. And here they give you an example of Federal Express's balance sheet. All right, notice how they show the accumulated depreciation as a number that's subtracted. All right, so here's your deferred revenue. All right, and just to review the example, right, when the customer pays us in advance, that's a liability. It's not revenue. We only have revenue when we do for the customer what we said we would do. So in this example, the customers paid us $600 in advance, debit, cash, credit, deferred revenue. And they did this on December 23rd. But between December 23rd and December 31st, we did some work for that customer. We did 4 sessions. The customer paid us in advance for 12 sessions times $50 a session. But during December, we provided 4 of the sessions. So 4 times 50 is $200. Of that $600, 200 of it has been earned, right? See services provided. So if the customer paid us in advance $600 and we did $200 worth of the work, how much still remains? We still owe the customer $400 worth of services. What entry gets made? Debit deferred revenue, credit service revenue for the work that was completed. Right, and here's Lowe's company. Right, they have deferred revenue. Notice it's listed with the liabilities, right? Now, I know we're going through this fast, and you're going to have to spend time on your own going over this. This is not the easiest thing in the world to understand, right? So be prepared to spend some time with this. Or what's an accrued expense? It's an expense that has been incurred, but it hasn't been recorded, right? And in this example, they're giving us three: salaries, utilities, and interest. And notice what they say here. Each of these items represents costs used to operate the company during the month of December. So let's look at salaries for an example. Remember we said, I just told you a few minutes ago, that most people get paid on Friday, but next week, Friday is October 2nd. So you have 3 days in that 5-day paycheck that you're going to get next Friday. 3 of those days were for work you did in September, and the other 2 days are for work that you did in October. So if you're preparing financial statements at the end of September, you need to get those 3 days in there. You need to record those 3 days. Now here, right, they're saying that the last time people got paid was December 28th, and the next time they're going to get paid is January 4th. So December 31st kind of pops up in the middle there. So if the employees earn $700 a week, $300 of those salaries was in December, and the other $400 will be recorded in January. Right? Debit salaries expense, credit salaries payable. Okay, now here, this is the example I gave you before with the telephone bill. They're just saying utilities. At the end of December, they receive a utility bill for $900 associated with operations in December. And the bill isn't due until January 6th. Well, January 6th is next month. We want to make sure that we record all the expenses that we had for this month. So even though the bill doesn't get paid till next month, we want to record this $900 as an expense for this month. So the adjusting entry would be a debit to utilities expense and a credit to utilities payable, or sometimes they would just say accounts payable, $900. Interest. If you go back to the example, they borrowed $10,000 from the bank. The interest on that is 12% a year or 1% a month. Right? So how much is 1 month's worth of interest? 1 month's worth of interest is $10,000 times 1% or $100. Now again, don't get hung up on the math so much. Just try to understand the concept of what's going on. They borrowed the money. They don't have to pay the money back for a while. I forget the 3 years. They don't have to pay the $10,000 back for 3 years. But they have to pay the interest every year. So how much interest accumulates every month on that loan? $100. So if they borrowed the money on December 1st, how much interest did they owe at the end of December? $100, right? The $100 that we just calculated. Debit interest expense, credit interest payable. right? Accrued revenue. A company has provided a product or service but hasn't gotten paid yet. So as soon as you recognize that you have a right to receive the payment, you have to make this adjusting entry. You debit an asset account and credit revenue. The asset account is going to be a receivable account, like accounts receivable, right? Now, here's an example of interest receivable. If we go back to this example here, interest payable. Debit interest expense, credit interest payable. This is the entry that's made by the borrower of the money, right? The borrower of the money debits interest expense and credits interest payable. What entry does the lender make, right? If this is a bank, what entry does the bank make for this? You're the borrower. Debit interest expense, credit interest payable. What entry should the bank make? Debit interest receivable, credit interest revenue. It's kind of the opposite, right, of what that is. So this is the entry that the bank would make, the lender would make for this same transaction that we saw here. Accounts receivable, they have accrued revenue for services to customers. How does something like that happen? You're just too busy to send a bill out. Typically, that's how that happens. You know, some people send their bills out the day after they provided the service. Others might not bill until the end of the week, whatever. The key to remember is that you did the work. When you did that work, you were entitled to get paid. So here's an example of they provided $700 of training to customers from December 28th to December 31st. The company has not yet collected cash or billed those customers, but since the work was done in December, it has to get recorded in December. Debit accounts receivable, credit service revenue. Okay. So with that, why don't we take a look at some of the homework? Okay. So in this problem, this is problem 3-3A in your textbook. Right now, you have to do this problem for homework, but when you do it, your numbers will be different, right? The numbers that I'm using here are the numbers that come right out of the textbook. Can I ask a question? Are you all still alive? Because I realize I've been talking my head. I don't hear much from you all.
Yes.
Okay, I get it. This is tough stuff, right? I get it. Okay. So the way I would approach doing this, now again, you got to keep in mind a couple of things. Look at the time period. July 1. So that's the first thing. When did it start? When does it end? It started July 1. It ended December 31. So I think that you're talking about a 6-month period, right? Okay. So let's talk about this now. Gamecock receives $6,000 from a customer for advertising services to be given evenly over the next 10 months. Gamecock credits deferred revenue. Record the adjusting entry for deferred revenue at its year-end, December 31st. Okay, so a common mistake people will make, instead of giving the adjusting entry, they give the original entry. What was the original entry? What entry got made on July 1st? Debit cash, credit deferred revenue for $6,000, right? That's the entry that was made on July 1st. That's not the entry we want here. The entry we want here is debit deferred revenue, right, and credit service revenue. So that's what we want. Those are the accounts that we want now when we make the adjustment. Now, what about the amount? $6,000 divided by 10 months is $600 a month. $600 a month. $600 for July, August, September, October, November, December. 600 times 6 is 3,600. 600 times 6 is 3,600, right? Okay. Now well, we'll see when we go through it. Here's number 2. At the beginning of the year, Gamecock's depreciable equipment has a cost of $28,000, a 4-year life, and no salvage value. The equipment is depreciated evenly over 4 years. Record the adjusting entry for depreciation at its year end of December 31st. Okay. So we're going to debit depreciation expense and credit accumulated depreciation, right? So that might be a good way to approach these things, is to say, okay, forget the numbers. What's the adjustment? And as soon as I see the word depreciation, that's telling me debit depreciation expense, credit accumulated depreciation. Now I have to worry about the amounts. They're saying at the beginning of the year, 28,000, 4-year life. What's $28,000 divided by 4? 7,000. 7,000. Okay. Now, see, in the other example, it was from July 1st to December 31st. That was 6 months, but in this case, it's a full 12 months, right? Because they're telling you beginning of the year versus end of the year. Okay. May 1st, 2021, and we're talking December 31st, 2021. How many months is that? That is 8 months. So the adjustment is going to be for an 8-month period, right? I can already see that. So on May 1st, 2021, the company pays $4,800 for a 2-year fire and liability policy and debits prepaid insurance. Debit prepaid insurance, credit cash. That was on May 1st. It's now December 31st. Debit insurance expense, credit, prepaid insurance. Now the amount. Now there's a couple of different ways to do the math for this, right? We could say, what's 4,800 times 8 over 24? Why 8? Because from May 1st to December 31st is 8 months. And why 24? Because it's a 2-year policy, right? 12 months in a year times 2 years is 24. So 4,800 times 8 over 24 is the same as 4,800 times 1/3. What's 4,800 times 1/3? Is that 1,600? Another way to do it would be this. If I have $4,800 for a 2-year policy $4,800 divided by 24 is $200 a month. And $200 a month times 8 months is $1,600, right? So either way, how you do the math isn't that important, but there's more than one way to get the answer, right? So debit insurance expense, credit prepaid insurance, $1,600. Okay. Now here, September 1st, December 31st. How many months is that? That is 4 months, isn't it? 4 months. So on September 1st, they borrow $20,000 from a local bank and they sign a note. Principal and interest at 12% will be paid a year later. Record the adjusting entry for interest at the year end. Now remember, when you see that word borrow, that's interest expense. Debit interest expense, credit interest payable. Now the amount. 12% is a great number because 12%, I should say this, anytime you see an interest rate in a problem, it's an annual rate. It's an annual rate. So if we're paying or doing, if we're calculating something that's less than a year, we have to break it down. Okay? So we could say 12% a year divided by 12 months is 1% a month. $20,000 times 1% is $200. And we need 4 months. So 4 times 200 is $800. Interest expense, $800. Interest payable, $800. Right? And again, when I click score answer, it should tell me. Okay. Supplies. At year end, there is a $2,700 balance in the supplies asset account. Right? What adjusting entry gets made for supplies? Debit supplies expense, credit supplies. Now we'll figure the number. At year end, when I look at the account, when I go to my trial balance and I look at the accounts and I see that there's a $2,700 balance in the supplies account. But when I went to the closet where I keep the supplies, I counted what was there and there was only 1,000 there. So what must have happened? If I bought $2,700 worth of something, right? Look at it this way. What if you bought, what do you like to eat? What if you bought $2,700 worth of donuts? Right? Because you were having a party, and at the end of the party, there were only $1,000 worth of donuts left. What does that mean? $1,700 worth of donuts got eaten. So what happened here? We bought $2,700 worth of supplies, but when the month was over, or when the time period was over, notice it doesn't even tell you when you bought the supplies because it doesn't matter. You only had 1,000 left. So what does that mean? 2,700 minus 1,000 means 1,700 got used up. And that's okay. That's why you bought them, right? You bought them because your employees need to use them. Okay, so all my answers were correct, right? All right, let's see how much time was left. Oh, got time. Let's do another one. Now you'll notice that a lot of this stuff repeats, right? Here's a 2-year policy, a 3-year policy. The other problem was a 2-year policy, right? So this is the next problem. This is number 4A, 3-4A. Buzzard Bicycles. We should probably read the beginning. Buzzard Bicycles specializes in custom painting and design of bicycles. December 31st is the company's year end. Information necessary to prepare the year-end adjusting entries appears below. Notice it says year-end adjusting entries, right? Not month-end, year-end. Record the necessary adjusting entries on December 31st. Do not round into me. Okay. A 3-year policy was purchased on July 1 for $18,000. The company debited prepaid insurance for the entire amount. Record the adjusting entry for insurance at its year-end, December 31st. Okay. So the adjusting entry will be a debit to insurance expense and a credit to prepaid insurance. Now, let's figure the amount. Now, last time, the way I did this, I took the amount of the insurance and I divided it by the period. Now, the period would be 6 months out of 36, which is 1/6. 18,000 times 1/6, right? Or 18,000 divided by 6. Is that 3,000? Right, that's 3,000. Okay, now if you don't like to do things that way, what else could you say? You could say that this is an $18,000 policy and I'm going to keep it for 3 years, and 3 years is 36 months. That's $500 a month. How many months have passed from July 1st to December 31st? That's 6 months. 500 times 6 is $3,000, right? So there's more than one way to get some of these answers. Debit insurance expense, credit prepaid insurance. Salaries. Now, as soon as you see salaries, what should you be thinking? What adjustment gets made for salaries? Debit salaries expense, right? And credit salaries payable. Right, now we'll work on the math. Employee salaries of $25,000 for the month of December will be paid in early January. But we don't even have to do any calculation there. They gave us a number. Right? That was almost too easy, right? Okay. All right, what do we have here now? On November 1st, the company received $6,000 from a customer in cash, or $6,000 in cash from a customer requesting a custom design for 6 identical bikes, $1,000 a piece, right? 6,000 divided by 6, $1,000 a bike. Deferred revenue was credited for the entire amount. So on November 1st, we debited cash and we credited deferred revenue. By the end of the year, 4 of the bikes have been completed. What adjusting entry do we make for that? Debit deferred revenue and credit service revenue. How much? 4 bikes have been completed and each bike is $1,000. Debit deferred revenue, credit service revenue, $4,000. Supplies. Supplies, okay, and they threw a wrinkle here. But what adjustment do we make for supplies, right? As soon as you see the word supplies, debit supplies expense and credit supplies. Now we got to do the math. They started the year with $2,000 worth of supplies, right? They started the year with $2,000 worth of supplies. During 2021, additional supplies of $18,000 were purchased. Okay, now $18,000 plus $2,000 is $20,000. At the end of the year, they had $4,000. Well, if I had $2,000 to start and I added 18, that means that the most I could have had at any one time was 20. But if I have 4 left, that means what? 20,000 minus 4,000, that means 16,000 were used. Okay. Number 5, advertising. Now remember, this is a bicycle shop and they are buying advertising. So this isn't the company that's selling the advertising. This is the company that's buying the advertising. If I prepay for advertising, it's an asset, right? Like prepaid insurance, prepaid rent, prepaid advertising. It's the same idea. Buzzard paid a local radio station $12,000 for 4 months of advertising on December 1st. The advertising will appear evenly over the 4-month period. So what's 12,000 divided by 4? That's $3,000 a month. The company debited prepaid advertising for the entire amount. That was back on December 1st. Record the adjusting entry for advertising at the end of the year. Okay, well, advertising expense and prepaid advertising, right? Just like insurance expense, prepaid insurance, rent expense, prepaid rent, advertising expense, prepaid advertising. What about the amount? Well, we just figured that if it's a $12,000 over 4 months, that's $3,000 a month, and the period we're adjusting is how much? It's 1 month, right? From December 1st to December 31st is 1 month, 3,000. Okay, now we have the interest business again. Buzzard borrowed $36,000 on March 1st. So as soon as I see that they want interest, I'm going to debit interest expense, and I'm going to credit interest payable, right? That's the easy part. Now the math. They borrowed $36,000 on March 1st. The principal is due to be collected in 5 years. Interest is receivable each March 1st. They should have said payable, because receivable would be the lender, at an annual rate of 10%. Record the adjusting entry for interest at its year end, December 31st. All right, so here, what's the formula for interest? It's principal times rate times time. So the principal is $36,000. The rate is 10%. Now, if I multiply 36,000 times 10%, I get 3,600. That's a year's worth of interest. How many months do we want? We don't want a year. How many months do we want? How long is it from March 1st to December 31st? It's 10 months. So what's 3,600 times 10 over 12? Or, right, if you don't like that, you could say this. You could say $3,600 is a year's worth of interest. 3,600 divided by 12 months is $300 a month. And how many months do we want? 10. So interest expense is $3,000. Okay, so here's all my answers. Let's score it. So far, so good, class. I'm on a hot streak this week. Last couple of weeks, I messed something up each time. Okay. Now, these next two problems are long. So let's just look at them. We're not going to do them now. We'll just look at them. Okay? Before I do that, though, let's just check and see when chapter 3 is due. Because right now you should be finishing chapter 2 and you should be taking your test, right? So we're a little ahead. When is chapter 3 due? Chapter 3 isn't due until October 16th. That seems like a lifetime away from now, doesn't it? Let's take a look at the next two problems. In the textbook, this is problem 3-5A. 3-5A. Boilermaker Unlimited specializes in new homes and remodeling existing homes. Remodeling projects include adding game rooms, changing kitchen cabinets and countertops, and updating bathrooms. Below is the year-end adjusted trial balance of Boilermaker Unlimited. Yeah, there's something here that I probably should have showed you. Come on. Something here that I should have showed you. Okay, now after the adjusting entries are prepared, right? So we learned how to make the adjusting entries here, which is the key part of this chapter, because the other stuff is similar to what we've done before. So if I make those adjusting journal entries and then I post those numbers to the accounts, a lot of students, I remember when I was a student, I used to say, gee, do you really want us to post those entries to the account? Of course, what's the point? Why would you do it if you're not going to post them to the account? You take those adjusting entries and you post them to the accounts, and then you need to do another trial balance. Right, so here's the adjusting entries that were in the example in the textbook. Here they get posted to the accounts, and notice the adjusting entries are in red. Notice not every account gets adjusted. Notice cash never adjusted, right? Never ever adjusted. The amounts in red represent the adjusting entries, right? Then it's time to do another trial balance. So after the adjusting entries are posted to the accounts, we have to do another trial balance. Because again, anytime you put numbers in the accounts, you're taking a risk. You might make a mistake doing that. So that's why you have to do a trial balance again. Right? So 46,600 debits, 46,600 credits. Now, these are the numbers that are going to actually go on the financial statements. So from the adjusted trial balance, you can prepare your financial statements first, income statement first, just like always, stockholders' equity statement second, balance sheet last. But notice you have all the accounts. Look, here's all the income statement accounts. You see them? Right? So now to do an income statement is no big deal. All you got to do is just take these numbers and put them on an income statement. Right? And then they show you that. Here's the adjusted trial balance. Here's the income. They color coded it for you, right? The income statement numbers over here, they're in blue. The stockholders' equity statement numbers here, see, they're kind of in this red or purple. And the balance sheet numbers in green. See them? Right? So we can do our financial statements off the adjusted trial balance. Okay? Now, the reason I'm mentioning that to you is because That's what they want us to do in this problem. So they're giving us the adjusted trial balance for this company, Boilermaker, right? And they want you to do an income statement, stockholders' equity statement, balance sheet. Okay. Now, the last problem, and again, this is, let's see, it won't let me answer I hate when it does that. Okay. Let's see if I can look at it this way. Here's the last homework problem. Now, this problem is a long one. So again, this isn't due for a while, but this problem, this could take you an hour or two, right? This is problem 3-8A. The name of the company is Red Storm, right? Red Storm, the general ledger of Red Storm Cleaners at July 1st, 2021 includes the following balances. Now, this problem has everything in it from when we started, right? This problem is like a review of everything that we've learned. So they give you balances to put in the accounts on January 1st. Then they show you transactions that occurred during 2021. Record those transactions, right? Take these transactions here and put them in general journal form. Put the numbers in the accounts. Do they ask for the accounts? I can't see if they have accounts. They should. I don't see how you can do this without accounts. Then you do a trial balance. Then you make your adjusting entries, right? There's only 3 of them. Then you do your adjusted trial balance. Then you prepare your financials, right? And then there's one more step called closing. I'm going to wait until I do the problem with you to show you closing. It'll make much more sense if we wait to do it till then. Because if I show it to you now, to be honest, you probably won't remember because you've got so many other things you have to do before that. All right, so that's chapter 3. Now we have some time. Let's see, how much? That's due on the 16th, right? Let's see. So today we're the 23rd, we're the 30th. So we've got 1. Then we got the 7th, 14th. We've got 1, 2. We got 3 more classes we can spend on this. All right, and I would like to do that. I don't want to get too far ahead. Right now, it looks like we're close to a week ahead, which is kind of good because this is a topic that we really should spend extra time on. But this one problem here, this would probably take an entire class period to go over from beginning to end. Okay, so the next class will go over problem 3. Well, whatever problem it was, Boilermaker was 3-5. And then maybe we'll do some other exercises and stuff to get more practice doing adjusting entries. Right, but you can see that this is a tough topic. This is the toughest thing we've done so far. Does anybody have any questions about anything? No? You are still alive?
Yeah, still here.
Okay. Right, so if there's no more questions, why don't we call it quits here? Right, and you know, first order of business is your chapter 2 homework. Make sure that's finished. Let me see.
When is that due, Professor? Because my Blackboard
Friday.
seems not to be working.
It's due Friday.
Oh, this Friday? Okay.
6 students have finished it, 11 students are in progress, and 4 students are waiting for an invitation, right? So you've only got until Friday to get this done. And again, don't wait until the last minute, please, right? Because you first of all, you probably won't get it right, and you just put yourself under pressure for no reason, right? Get your work done. Don't wait until the last minute. So the first order of business for you all is to make sure you finish the homework, chapter 2 homework. The second order of business is the exam, right? Exam 1. And you can take exam 1 anytime between tomorrow and the 29th. The 29th is next Tuesday. Right? So that's the second order of business. And the third order would be the chapter 3 to at least go over some of what I went over with you today. Maybe get 1 or 2 of the homework problems out of the way. But make sure you have your chapter 2 and your exam done before you do that. All right, guys? Anything else?
That's all.
All right.
Well, what was the exam? The chapter 1 and
Exam
was
is 1 and 2.
1 and 2? Okay.
Right, anything else? Okay, well, if that's it, then I will see you next week.
Have a good day.
Good day, Professor.
Bye.